Hi, good morning, everyone. My name is Tony McKillip, President of Life Insurance Trust Company. We certainly appreciate everyone joining today's webinar on privately held business valuation for trust. We hope you find this presentation informative and useful. Joining me today are Eric Scow, Chief Operating Officer of ITM, and Josh Obregon, Operations Supervisor for ITM. Before we get started today, I wanted to just give a brief overview of Life Insurance Trust Company and our affiliate ITM. Life Insurance Trust Company is a South Dakota-based trust company that focuses exclusively on the administration of insurance policies held in irrevocable trust. We partner with many banks, trust companies, financial advisors, CPAs, and attorneys to serve as successor trustee and act as a strategic partner for those with new or existing ILITs looking to exit the business. Since Life Insurance Trust Company's inception, we have onboarded over 5,000 ILITs. There are many advantages to our successor trustee model, including eliminating costs associated with administering these accounts. As a true strategic partner, we offer the opportunity for the former organization to receive funds back once the insurance policy has funded. Finally, you can eliminate risks associated with the administration, redeploy resources, and continue to stay involved through the online portal and our advisor-friendly model. I will now turn it over to Eric Scow to discuss a little about ITM and their services before we dive into today's presentation.
Thank you very much, Tony. I'm Eric Scow with ITM. I want to start by thanking everyone for joining us today. For a little background on our organization, we were founded in 2001, and we were started to assist institutional trustees with the management of their life insurance policies held in irrevocable life insurance trusts. We currently partner with over 300 bank and trust companies and assist them with the management of over 20,000 life insurance policies. Our solution helps bank and trust companies reduce costs and mitigate their liability. In 2013, our organization began offering our Value Monitor solution, as many of our clients had the need for fair market value estimates on privately held businesses within their trust accounts and IRAs. In 2017, a valued client asked if we could provide them an application to help them manage their will files. Our Will Monitor solution allowed trustees to track executor and trustee relationships, monitor potential deaths, and build relationships with beneficiaries and outside parties such as attorneys and accountants. With more specifics on our Value Monitor solution, it's designed to provide our clients with independent and objective valuation reports that comply with IRS Revenue Ruling 5960. Just some statistics regarding the overall industry. In the United States, there's approximately 33.2 million privately held businesses. Surveys of business owners have indicated that 50% of respondents are planning for an ownership transfer within the next 5 years, and 70% are planning to transition within the next 10 years. A recent survey conducted by the Exit Planning Institute indicates that financial advisors are currently the most trusted resource for succession planning. So it's really imperative that trustees and financial advisors have sound communication to ensure all their clients' needs are being met. Regarding our internal expertise, we have over 1,000 active assets that we perform valuations on, provide fair market values on. And our team has valued organizations in over 200 different industries.
Great. Hey, Eric, are there any specific credentials that you would need to value these companies, or could a CPA simply do this?
A CPA could assist with regards to our organization. The credentials that we believe are most important in valuing privately held companies are the Accredited Senior Appraiser in Business Valuation, or ASA designation from the American Society of Appraisers, and the Certified Valuation Analyst designation from the National Association of Certified Valuation Analysts, or the NACVA. Due to the complex nature of appraisal work, it is essential that appraisers are educated and have valuation experience. Both the ASA and CVA designations have extensive coursework, followed by a testing requirement to ensure individuals have strong foundational knowledge of valuations. In addition, the ASA has a 5-year valuation experience requirement. For our staff, our team valuation members have the ASA and CVA designations, and one of our individuals also has a CFA designation.
Thank you for that, Eric. Yeah, great. I hear a lot about this fair market value and making sure that we have the valuation is that of fair market value. What exactly is fair market value, and why would that be important to business owners?
Hi, Tony, that is a great question. So fair market value in business valuation terms is the price expressed in terms of cash equivalent at which a property would exchange hands between a hypothetical willing and able buyer and a hypothetical willing and able seller, acting at arm's length in an open and unrestricted market when neither is under compulsion to buy or sell when they have the reasonable facts of knowledge in it. That is the straight definition provided by the International Glossary of Business Terms. It is the most widely recognized standard of value. So there are two others in addition to fair market value. It is fair value and investment value. However, when looking at taxable implications, the IRS requires fair market value. So it is essentially the cornerstone of all business valuations.
Mm-hmm. What valuation standards would you follow?
So when deriving the fair market value, we follow the guidance that was prescribed by the IRS ruling 5960. It gives certain factors that must be considered at minimum when valuing closely held entities or privately held businesses. Straight from the revenue ruling, the nature of business and history of the enterprise from its inception, the economic outlook and industry conditions, the book value of the stock, the earning capacity of the business, the dividend paying capacity, goodwill, prior sales, and any market price transactions that have occurred in publicly traded companies. These points here set the standard of how business valuation or businesses are valued and the appropriate methods to value them. In addition to the IRS ruling, we also follow the standards put on by the ASA, so the American Society of Appraisers. These set, similar to the IRS ruling, the minimum criteria that must be considered when valuing these businesses. So the three main approaches for the IRS and ASA business valuation standards that can be considered or must be considered are the market approach. So the market approach is essentially looking at private company transactions, private or public company transactions, as well as multiples comparable to the company for publicly traded companies. You derive a multiple and apply that to a certain valuation metric, whether that's revenue, EBITDA, cash flow, to derive a value. The income approach is the second one, so that is taking a defined benefit stream. So if that's net income, equity cash flow, gross capital cash flow, you apply a capitalization rate to the defined benefit stream and capitalize that to get the value of the company. So in the income approach, there are two methods: a capitalization of earnings, which is just a single period capitalization method, or the discounted cash flow method, which is projecting cash flows into the future and discounting them back to present value. The third approach is the cost approach. That is simply marking up the company's assets to market value from book value and subtracting out any liabilities to get the fair market value of equity. Then also one question that we get a lot is regarding discounts. So for discounts, there are two main discounts. The first one's the discount for lack of control, which is applied in instances where a minority interest does not have control of the company's operations and cannot make decisions. Typically, those restrictions are found in companies' operating agreements, partnership agreements, bylaws, and reading those is essential to understanding what restrictions come when looking at control. Also, there's a discount for lack of marketability. That is the discount applied to an interest or a company for not having a readily available market to sell an interest in the privately held company. Similar to the discounts for lack of control, restrictions in the operating agreement, whether that's dividend paying, transfer restrictions, withdrawal provisions, all play a factor in looking at marketability.
Great. Certainly a lot that goes into these and a lot of regulations to comply with. What services would your organization provide that could help, meet IRS guidelines?
Yeah, so we offer two valuation reports. The first one's a calculation report, which coincides with an IRA calculation report. These reports are limited in scope, but still adhere to the revenue ruling 5960. They are primarily used for regulatory compliance, filling out Form 5498 for assets held in IRAs, and they are more designed to give an indication of value, but not a true formal appraisal, which the second service we offer is a formal appraisal. These are designed to adhere to the business valuation standards. They're US compliant or USPAP compliant, and they satisfy the IRS's requirement for a fair market value appraisal when dealing with gift tax or estate tax. Buy-sell considerations may also require a formal appraisal as well. So any taxable event, the IRS will require a formal appraisal, and the calculation reports would not adhere to those standards.
Great. I know there's inevitably times when trustees are going to hold, businesses and they're going to need these, market values. What are situations when a trustee should or might need these market valuations?
So as I previously mentioned, taxable events, this would be one of the main reasons to get a fair market value. So any gifting that has occurred, an estate tax valuation, charitable contribution, and even potential sale purposes. So if a trustee has an interest, they will want to get a fair market value to see if the sale price that they're being offered is adequate enough. Also, regulatory compliance reports. So any Reg 9 reporting will require a fair market value. If the trustee is a trustee of a unit trust, they will require an annual distribution based on the fair market value of the asset. So that asset will require a fair market value indication, as well as assets held in IRAs. They require a fair market value to be filled out on the 5498.
Great.
Yeah, and from my perspective, in estate planning, it's very important, especially in 2017, the Tax Cut and Jobs Act increased the exemption amount to $13.61 million per individual and $27.22 million per married couple. This exemption allows that amount of money to be passed to heirs without incurring any federal estate taxes. At the end of 2025, those amounts will reduce to $7 million for individuals and $14 million for married couples, adjusted for inflation. With the possible sunset of the TCJA, it is imperative that estate plans be reviewed and updated if needed. Discussions for performing strategic gifting to take advantage of the higher exemption amount should occur. If the estate contains a privately held company, it is important to understand the fair market value of that company in the planning process. In some cases, that privately held company can be a significant portion of the overall estate. An irrevocable trust may be a tool that can be used. Should an individual decide to directly gift up to that higher lifetime exemption amount prior to sunset, the irrevocable trust can provide protection for family members versus gifting that amount directly to individuals. In determining the assets to gift, it's always preferable to favor assets that are expected to continue to grow into the future. Having consistent fair market value reports produced can assist in determining if a privately held company is growing. And another area is in the business succession planning. Understanding the fair market value of a privately held company is important in the succession planning process, as during this process, it's important to balance the business dynamics with the goals of the owner. A fair market value can be helpful in understanding if the value of business will be transferred to family members or employees, and it can also be useful if the business will be sold to an external buyer, as it can help identify areas in financial statements that can be improved upon to help really maximize the value an external buyer may pay for that asset.
Great, thank you. Certainly a lot of reasons, trustees would need that fair market value then. And can you maybe provide just some real life examples of the services that you provided and how they've impacted the clients and trustees?
Yeah, so the first one is a calculation report that kind of touched on what Eric was talking about succession planning and estate planning. We were approached by a client who owned 100% of a plumbing company. He and his financial advisor were looking to kind of understand what the fair market value of the company was worth, because they've never had a fair market valuation completed before. So when we looked at this, they identified two options they were considering, whether that was selling the business to an external buyer or gifting to children. We prepared a valuation or a calculation report that adhered to the standards we follow and derived a fair market value. This helped them understand what the business was worth and also what taxable implications would arise shall he gifted it to the children. After completing this, we walked them through, we talked about all the metrics that we considered in valuing the company, the approaches we used, and I think overall it gave the client a good understanding of what the business is worth so he can properly plan for the future.
Great. Great. How about for formal appraisal for gifting purposes?
Yeah.
When would be a case that you did on this particular topic here?
Certainly. So this one is, in my eyes, a pretty straightforward formal appraisal valuation situation. We had a client that gifted shares of a minority shares in a real estate company to two trusts. So since it is a gifting instance, it is a taxable event. So he was required to get a valuation completed to satisfy the 709 gift tax return. I wanted to point this one out because it also comes into play of getting a fair market value indication. So we previously had done a valuation of this company, I think about 4 years prior. It is a real estate holding company, and given the economic environment, the value of the real estate increased. So between the 2 years, the share price of the company doubled. And had they not gotten a fair market value indication, a current one, they would have relied on an older valuation, which could have caused some problems with the IRS, and it more than likely would have been reviewed. And they would have ended up paying less in taxes based on the lower value of the previous one compared to getting the appropriate value and making sure everything is up to date and correct.
Great. Some real nice examples you gave. Are there any other considerations trustees should be aware of in assessing their privately held companies and trust?
Yeah, I would start with a very sound pre-acceptance review process. There's a need to understand the fiduciary duties related to specific entities to determine and identify any potential risks and liabilities before you take that asset on. For instance, the OCC requires internal policies with a pre-acceptance review process of all trust accounts. We recommend reviewing documents, the legal document agreement, partnership agreements, operating agreements, articles of incorporation, bylaws, including all amendments to those documents. You also should go through the trust agreement, including amendments, any last will and testaments, as a trust may be created through the last will and testament. You also want to review the corporate financial statements, prior tax filings, any K-1s, to determine if there's distributions being made. The assessment should include the ownership interests, the management responsibilities, your ownership liabilities, your withdrawal rights, and your diversification investment risk requirements. You want to really make sure that asset is productive with a history of paying distributions. The next item we would highly recommend you look at is the buy-sell agreements. Buy-sell agreements are used to protect against unwanted shareholders. Really understanding the provisions of those agreements is essential. The language in the agreement should refer to a defined valuation standard and have a strong understanding of trigger events. Recently, the Supreme Court made a ruling in Conley versus the United States where John Conley, a business owner with a buy-sell agreement in place, the court ruled in favor of the IRS in this case, affirming that the buy-sell agreement did not adequately reflect the fair market value of the business interest. This led to a substantial tax liability for the estate. This is where an outside firm can be used to provide a fair market value and can especially be useful when a trigger event occurs. The buy-sell agreement should establish an exit strategy for the owners, which reduces the potential for conflict later when that triggering event does occur. Our final recommendation would be to really understand the Corporate Transparency Act. On January 1st, 2021, Congress enacted the Corporate Transparency Act, or CTA, which was implemented to limit illicit activities and financial crimes through the use of shell companies. The act requires reporting of beneficial ownership of certain domestic and foreign entities to the U.S. Treasury Department Financial Crimes Enforcement Network, or FinCEN. The final beneficial ownership information rule under the act became effective on January 1st of 2024. So the domestic and foreign entities will be required to file reports with FinCEN where existing companies must file on or before January 1st, 2025. So that's a very important date for these privately held companies that do exist. You also must update with FinCEN every 30 days of any change in the entity or the beneficial ownership. New companies started in 2024, you have up to 90 days. After 2024, that requirement will change to 30 days. So you really have to understand with the new company being set up, those new filing requirements. Corporations, LLCs, LPs, LLPs, and business trusts must report if registered with the Secretary of the State and are doing business within the state and are not exempt from the reporting requirements. Just for definition, the beneficial owner is any individual who directly or indirectly exercises substantial control over that reporting company, or who directly or indirectly owns or controls 25% or more of the ownership interest of the reporting company. For trusts, it's really important that you understand the relationships, as significant interest requires the trustee to gather information on trustees with powers to dispose, beneficiaries who are sole income and principal or right to withdraw demand distribution, And all finally, the grantors of revocable trust with rights to withdraw assets from that trust. So you really have to understand the relationships between the trust, individuals, and that underlying business.
Great, certainly a lot to think about. And I know that, that would conclude our presentation. We will open it up for questions at this time. If any of the attendees have questions, there is a chat button in the webinar here that you can answer, type those in. We did have a couple questions come in, or at least one came in so far, and that is, are there any companies that you feel would be very hard to value, or would be tough to get a valuation on?
Yeah, Tony. So the majority of companies we see are operating companies or asset holding companies. So an operating company we kind of define as one that has sustainable operations. So a manufacturing company, a restaurant, a plumbing company, or an asset holding company owns real estate, whether that's multi-real estate, single real estate, as well as family limited partnerships who hold marketable securities. Those ones are the most common ones we see. However, there are what we call startup companies. So startup companies that are still in the early stages of developing a product, developing a service, where valuing those are almost purely speculative, and it's harder for valuation analysts to value those startup companies. There are instances where we are able to value these startup companies if there was a recent funding round. So if the startup company has multiple tranches of equity, we can take the most recent equity selling price and back solve for the fair market value of the whole company and filter that through kind of a waterfall process to the other tranches of equity, depending on what ownership's in the equity.
Great, thank you. Are there any other questions anybody had? It doesn't appear so. Well, that would conclude our webinar, and we much appreciate everyone joining today. Thank you so much for joining us. And with any questions or concerns, you can certainly reach out to myself or Josh, and we'd be happy to assist in any way we can.